24 breakout chart patterns explained, revealed, all here, ready for you. The ascending triangle is where the price of the market makes higher lows and same highs, which then converges to an apex, and then we wait for a breakout. And then you determine where the stop loss and take profit is. So where I put my stop loss and take profit is always, so 1 to 1.5 is my risk to reward ratio. Or when the market is trending and is doing well for us, the risk to reward is 1 to 2, which means I'm willing to risk 1 to make twice as much. So with the ascending triangle, once the price breaks up and out of the resistance, I get in and I set my stop loss pretty much halfway between the formation, sometimes below it, sometimes below the whole formation. And then I set my take profit twice as much as where I put my stop loss. There is no magic level where to put your take profit level. Some people use Fibonacci's, others use regression, others use Elliott waves. It's all changing chaos into order. It's all within your own confirmation bias, nothing else, okay? There are no magic indicators. So it's as simple as the risk to reward of 1 to 2 or 1 to 1.5. The ascending triangle was the first formation, and the opposite is a descending triangle where the price forms lower highs and it bounces on the same lows. Then the price of that pattern breaks below the support, and that's where you expect the market to continue down. And so you set your take profit twice as low as where you are willing to set your stop loss. That's the difference between an ascending triangle where it's ascending and a descending triangle where the price is moving down. Then you have a cup and handle, which is my favorite formation, which basically shows you a big rounding bottom and a small rounding bottom, which forms the handle, and a big rounding bottom that forms the cup. The price then breaks above, and I normally set my stop loss just below the bottom of the handle, and I set my take profit twice as high as where the risk is. So that's the cup and handle formation. Then you have an inverse cup and handle, where it's basically the opposite of a cup and handle. You're turning the cup and handle upside down, where it forms a big rounding top, which is the cup, and a small rounding top, which is the handle. And then the price breaks below the support of the cup, which is also known as the brim level. And then you set your take profit twice as low as where you would set your stop loss or your risk. So in this case, you would put your stop loss just above the handle, and you would set your take profit level twice as low. Bullish cup and handle formation, you're waiting for the cup and the handle to form, break out, and then you follow in the direction of the trend. And the inverse cup and handle is you wait for a rounding top, which is the cup, and a small rounding top, which is the handle, break below, and then you're going to follow the direction down. Then we have the double bottom, which is also known as the W formation. And basically this is a formation where there's two rounding bottoms. The price breaks up and out of a resistance level or a neckline. In this case, we call this a neckline. And then we follow the direction of the trend, and we set our stop loss 50% of the W formation. You then have the bearish formation, which is a double top, or the M formation, which forms two rounding tops. You wait for the price to break below the neckline, and then you will hold on to your trade as you expect the price to drop, and you will set your stop loss 50% in between the head of the double top and the bottom of the double top. Then we have a falling flag. Now, a falling flag is where the market has been moving in an upward direction and it has a flagpole. Then the price moves in between a range, and that range forms what looks like a flag. Not a pennant, not a triangle. And then we wait for the price to break up and out of the flag formation. We set the stop loss just below the bottom of the flag formation. So I like to give it some leeway. And then I set the take profit twice as high compared to where the stop loss is. So that's the falling flag. So the flagpole raises up, the price forms a falling flag, the price breaks above the falling flag, and then we ride it on up and take profits. The rising flag is where there is a downward trend line. It then forms a rising flag with the price. We then wait for the breakout below the rising flag, and then we expect the price to continue down. When there is a small recovery within the bigger downtrend, we expect the price to break below and continue down. As always, we set our stop loss just above the formation so that we can give leeway in case the market does test these levels. So that's the difference between falling flag and a rising flag. We then have the falling pennant and the rising pennant. The falling pennant is very similar to the falling flag, but the trend is moving up, and instead of forming a flag formation, it forms somewhat a wedge pattern, but it's also known as a pennant formation. Now, a pennant compared to a wedge is a lot shorter duration. When you think of a pennant, think of a short duration movement within an uptrend. So with a falling pennant, you expect the price to move down, and then once it reaches 3/4 of the apex, it will break above the falling pennant, and you expect the price to move up. And then you can set your stop loss just below the bottom of the pennant or give a little bit of leeway. Then you have the rising pennant where you have a downtrend. The price then moves in a triangular formation up and it forms a pennant formation, and then the price breaks below the rising pennant. Once that happens, you've got your levels. You've got your entry, which is immediately the open price of the candle that opened below the rising pennant. You have the stop loss if the price does decide to move up again. And then you've got the take profit where the price will continue down and you will bank your profit. Then we have the falling wedge and the rising wedge. Falling wedge is where the direction has been moving up in an uptrend. It then has a retracement of around 1 to 2 to 3 months of movement. Notice 1 to 2 to 3 months of movement within a wedge formation. The price then breaks up and out of the wedge formation, and you hold it because you expect the price to move up, and then you set your stop loss below the wedge formation to give it leeway. The rising wedge is the opposite of a falling wedge. It's when the price of the market has been coming down. You then expect the price of the market to form a rising wedge. Once the market breaks below the rising wedge, that's where you get in. You set your stop loss above the rising wedge, and then you set your take profit twice as much of what you're willing to risk. The inverse head and shoulders is a bullish formation where it forms a small rounding bottom, which is known as the left shoulder, a big rounding bottom, which is the head, and a small rounding bottom, which is the right shoulder. The price goes up and down until it hits a neckline. The price breaks above the neckline where you go long or you buy, and you set your stop loss below the bottom of the right shoulder. And then you ride it on up until it hits the take profit. The opposite of an inverse head and shoulders is a head and shoulders, where it forms a rounding top, a bigger rounding top, and a smaller rounding top again. So the left shoulder, the head, and the right shoulder, the price breaks below the neckline. You set your stop loss above the top of the right shoulder. You set the take profit at about 2 times more than what you're willing to risk at around this level. The rectangle formation, bullish. You wait for the price to form in a rectangle formation. The price breaks above the resistance where you get in. You set your stop loss, sometimes 50% of the rectangle formation. If it's a small rectangle formation, then set your stop loss below the entire formation, but make sure the take profit is twice as much of what you're willing to risk. The opposite is a rectangle formation, but bear it. The price forms a box formation, and instead of breaking up, it breaks down. You set your stop loss at 50% of the height of the box formation or above the box formation resistance, and you set your take profit twice as much that you're willing to risk. Then we have a simple rounding bottom. One of the easiest formations you see, it's quite common. So you see a big rounding bottom form. There is a neckline. The price breaks above the rounding bottom. That's where you hold it. You set your stop loss about 50% of the height or below the rounding bottom, depending on what you want to do. And then the rounding top is the opposite, where it forms a rounding top formation. It then has a stop loss 50% of the height. And then you set your take profit way below, about 2 times of what you're willing to risk. Now, a symmetrical triangle is similar to a wedge, is similar to a pennant, except this is where the triangle is symmetrical. It moves in a sideways formation, and instead of converging on a downtrend or an uptrend, it converges sideways. And then you're waiting for the price to break up and out of the symmetrical triangle. This is bullish. Then you set your stop loss just below the symmetrical triangle. You set your take profit way above 2 times. And the opposite we have is a symmetrical triangle bearish. And this is where the price is coming down. It forms a symmetrical triangle. It breaks below. You set your take profit twice as much as what you're willing to risk. So I like to set my stop loss just above the resistance of the symmetrical triangles. We always want to prevent fake outs with trading, and we do this through experience. Triple bottom, it has 3 rounding bottoms. It has a neckline, and you wait for the price to break above the neckline. You then hold on. You set your stop loss 50% of the height or below it. The opposite is a triple top. You wait for the price to break below. You set your stop loss 50% of the height, or you set the stop loss above the formation itself, and you make sure that to take profit is 2 times of what you're willing to risk. The broadening bottom, or what I call a vuvuzela formation. If you've been with me since 2013, you would know exactly what I'm talking about. So broadening bottom is where the price broadens and forms a triangle formation, but broadens from the beginning of the formation to the end, and then it breaks out of the broadening formation. I like to set the stop loss below the entire broadening formation and the take profit 2 times higher. And then we have a broadening top, which looks more like a vuvuzela, where the price forms a broadening formation where the price hits higher highs and higher lows. This is more of a subjective type of formation that you can see when it's converging out, and it forms a broadening top formation. And then you can set your stop loss either 50% of the broadening formation above the broadening formation. But the most important thing is to set your take profit twice as much as what you're willing to risk.